Hey y'all, this is Mindy Strong, and I've created another video for you to help you prepare for the Series 65. These videos are just created to help go over the general concepts. We are looking at the financial profile of a client, so we're in the third section that you need to study for the Series 65 test. I created these to help myself as I was studying, and then I decided to turn them into videos to help others. So, without further ado, we are going to look at the financial profile of a client. First of all, we have personal customers. Now, we need to find out some things about our clients. What is their current financial status? What's their family composition? What's their tax situation? And what is their employment information? We need to know their financial goals, investment objectives, their investment knowledge, employment information, their risk tolerance, and their investment time horizon. When it comes to their financial status, what are their assets? Cash, marketable securities? What's not readily available? What investments do they have in retirement plans? What's the value of their tangible assets, and what's the value of their automobile? And what are their liabilities? What are their credit card payments? Household bills. Household is spelled wrong there on purpose, just to make sure you're paying attention. What personal notes do they owe on? What secured loans do they have? We need to look at their income. We take all anticipated expenses, and we want to add a little reserve in there. The value of assets pledged as collateral for secured loans must at least equal the loan. That makes sense. That's logical. And the market value of cash and marketable securities must be greater than all of their unsecured payables. That also makes sense. And look, she's stressed. She's going over all of her bills. Oh my gosh. What's the family makeup? Do you have young children? Is college in their future? Do you have other dependents? Are there medical issues that are not covered by insurance, either for you or for your dependents? And do you have elderly dependents? And then tell me about your taxes. Are you in a low tax bracket? If so, then taxable investments are okay because you're not going to be hit hard on taxes. Are you in a high tax bracket? If so, we want to look at tax sheltered, right? Choosing the right tax filing status is also important to minimize the tax liability as much as possible. Well, let's look at them. Unmarried head of household. You can claim this if you have at least one dependent child. That's the head of household part. And you pay at least half the bills. Qualifying widower. If your spouse has died in the past 2 years and you have at least one dependent child, you can be a qualifying widower. Married, filing jointly. One works, higher income is averaged down. Both can work, but at least one has to be working. Married, filing separately. This is usually better to claim if both make a lot of money and they have large itemized deductions. So that's when you would want to file separately. But there is a marriage penalty, and it's usually greater when there's more when the incomes are similar. Okay. Financial goals. Do you need to fund college? How many kids? What are their current ages? Do you need to fund your retirement? When do you plan on retiring? Are you married? Are you taking care of your aging parents, or do you predict that you're going to need to? Are you interested in paying off your mortgage early? Are there any major life purchases that you want to fund? You want a second house? You want to buy a boat? Is your job stable? How much time have you had with the company, and are there any changes on the horizon, either for you working there or the company as a whole? And then we need to do a capital needs analysis. This is going to be used to determine the amount of life insurance that's needed. People don't know when they are going to die, period. And therefore, we can have all of these financial goals, but until we meet those financial goals, we need to look at a capital needs analysis. What if you pass away tomorrow? What does that look like for your family? And the future income that is going to be needed with the use of that income, the amount, and the date. And these are all, of course, in case someone dies before their financial objectives are met. And what is your risk tolerance? We can have smaller annual payments into higher yielding stocks versus larger payments into lower yielding treasuries based on your risk tolerance. Obviously, the first is riskier. Financial goals, again, what's your current cash flow? Are you willing to spend less now and save more? What are your current vehicles that you're utilizing to make money? Are they appropriate? Are there fees involved? Can we move any of that without penalty? Are there tax consequences? What's your time horizon? Is that time horizon actually attainable, and is it reasonable? Who are you as a person? Are you a spender? Are you a saver? Is this person low income? What's your age? And what's your knowledge? All of this is important information that we need to know. And then we have our institutional customers. We need to look at the current assets, the cash, marketable securities, accounts receivable, and inventory. We know this. We've already gone through this in other videos. What are the current liabilities? Those are the accounts payable, the wages payable, the taxes payable, and the notes payable, all due within a year. That's why they're called current. We're not talking about long-term debt here. Liquid net worth. Those are cash assets over current liabilities. Liquid cash assets over current liabilities. If something isn't cash, then it's taken out of the current assets in order to determine the liquid net worth. And we have our fiduciary customers. Managing pension plans or endowment funds to fund a future benefit is a big responsibility, and the safety of principal is key here. We want to minimize potential for loss. We need to know the current investment positions, the anticipated future contributions to the portfolio, the anticipated future distributions from the portfolio, and regulatory constraints on the portfolio, restrictions. There are 3 types of tax rules we're going to look at. One of them is earned income. So that includes salaries and wages earned in an occupation, tips, royalties, bonuses, all of that is an earned income. Business expenses are deducted and they are taxable. Transfer payments and pension plans are not earned income, but they are taxable. So I wanted to make sure y'all understood that. Portfolio income. This is your investment income and or loss. Dividends and interest. Cash dividends are only taxed at 15%. Reinvested dividends are still taxable. We need to look at capital gain and loss. That's gains from the sale of assets, gains from the sale of stocks, options, bonds, mutual funds, artwork, even real estate. Those are all capital gains, and they're in the portfolio income. Now, your net capital loss cannot exceed $3,000 a year, but the additional is carried to the next year. But it's only in like loss. So, for instance, if you have $3,000 in passive income loss, then that's your max in passive. So it's only in like loss. 12 months or less, if you hold on to something in your portfolio for 12 months or less, then you're going to be taxed at 37%. If you hold on to it for more than 12 months before selling it, then you have a lower tax rate. 15 to 20% is the highest there. So it makes sense to hold on to things. Avoid that extra up to 17% of tax. And when it comes to your personal residence, the first $250,000 is excluded from capital gains. It's not taxed as long as you've had the property for at least 2 years, and that amount goes to $500,000 if you're married. And then we have passive income. This is income from real estate investments and limited partnership interests. They're tax sheltered. We've also talked about those in other videos. Okay, Section 1031. This is a tax benefit given to real estate investments. And basically, what it says is capital gain taxes that are due can be deferred by buying another investment property of the same or greater value. This gets people to keep their money in real estate. Smart. Way to avoid paying taxes on it, on the capital gains. There is also a 3.8% Medicare tax on unearned income. And now we're going to look at two separate classes of taxes. Either it is progressive or it is regressive. Progressive tax is our personal income tax. There are 6 tax brackets. They range from 10% up to 37%. It's a person's income that determines what bracket they're in and therefore how much they pay in taxes. Progressive. More money you make, the higher percentage you will be taxed at. And then there is a regressive tax. This is the same for everyone. Poor people and rich people pay the same amount of tax. An example is sales tax. Doesn't matter how much money you have in the bank. If you go to buy that widget at the store and there's a sales tax on it, we're all going to pay the same amount. All flat rate taxes are regressive. Now let's look at the tax treatment of stocks. First of all, there's 15% tax rate on dividends. Okay, something to know. Now remember, short term, held for 12 months or less. Long term, you have the max of 15 to 20% tax. So there's a reason to hold on to things. The definition of cost basis, also known as tax basis, again, we've gone over this before, but let's go over it again. That's the original value or purchase price of the asset or the investment. Now, commission is not deductible for tax purposes. Okay, know that. The dividend received from common and preferred stocks are taxable as investment income in the year they're received, and the expenses are deductible. Okay, the dividends received are taxable as investment income in the year they're received, and expenses are deductible. It makes sense. It's logical. They're going to get their taxes on this money that you've been given. Sale proceeds. Commission, again, is not deductible as income, but it does reduce the taxable sale proceeds when sold. So that's cool. Tax treatment of corporate, treasury, and foreign government bonds. Up to 30% of tax on interest payments. Interest received is taxable in the year it's received, and expenses are deductible. Cost basis, tax basis, includes the commission, but doesn't include the interest. Okay, and then we have sale proceeds, doesn't include the commission, and doesn't include interest. Got it. Tax treatment of municipal bonds. We've learned about municipal bonds. Interest income is not taxable, so the expenses associated with holding the municipal bonds, the munis, are not tax deductible. They can't tax the interest, so they can't ignore or deduct the expenses. Got it. They're going to get their money. Okay. You may very well be asked to compare a municipal to a corporate bond and the yields that each would give you. Remember, since munis aren't taxable, the interest isn't taxable, they may very well say, hey, this municipal bond will give you this percent interest and this corporate bond will give you this percent. How do they compare when we eliminate the difference in taxes? Remember that division makes things smaller. Always. Okay? So, you take your tax-free yield. So, the equivalent taxable yield, you take your tax-free yield, which is going to be your municipal bond interest, and you're going to divide that by 100 minus whatever this person's tax bracket is, and that gives the taxable yield. Okay, the equivalent tax-free yield. So you take the corporate bond yield and you multiply that by 100 minus the tax bracket, and that gives you the equivalent tax-free yield, and you will be able to compare the interest you would receive from a municipal bond, which is not taxable, versus the interest you would get from a corporate bond after taxes. Because on paper, corporate bonds are going to look like they're going to make you more, right? Because they have to account for interest. So generally, they're going to present as higher, but you've got to take the taxes out to really understand what you're going to get. Here's an example problem. Look, how exciting. A person is choosing between buying a 10% corporate bond and a 7% municipal bond. They're in the 15% tax bracket, which would give them the higher equivalent yield. Okay, we have our two formulas. So we take the tax-free yield, 7%. We divide that by 100 minus 15, so that means 85%. 7% divided by 85% is 8.24%. We look at the equivalent tax-free yield, taxable yield times 100 minus the tax bracket. So we take that 10% and that becomes 8.5%. So in this case, when comparing them, which one is going to give us the better yield? The corporate bond, right? The corporate bond is going to give us the better yield when you compare them. Okay, cool. Makes sense. Now let's look at donations taxes. Okay, tax deduction to a charity is equal to the market value at the time of donation. The market value when the donation is made. Doesn't matter what they bought it for. It doesn't matter if they give it to someone else what that person sells it for. It doesn't matter what it's worth 6 months or a year after they sell it. It is equal to the market value at the time they donate it. Now, there's one little asterisk here. They must have held it for 1 year first. And as long as they've done that, then no tax is payable on the increase in the cost after 1 year. If they've held it for less than a year, they're only going to get the cost of the position deduction when they bought it, not the fair market value, equal to what it is at the time they donate it. So they have to have held on to it for a year. Now, the current market value becomes the cost basis for the recipient. Got it? Now, here's another little asterisk. Inherited securities are taxed at fair market value at the date of death. At the date of death. Okay. Here's my little example. I make myself laugh. When gifting personal property to anyone else other than a charity, if the person sells the item, they're charged capital gains or loss by taking the value originally purchased for less the sales price, and capital gain tax must be paid. So she was gifted with personal property. She, in turn, decides to sell it. And guess what? Capital gains must be paid on that. Taking the value originally purchased for less the sales price. Let's look at corporate and trust income taxes. Tax rates are generally higher for corporations than individual rates. Form 1041 must be filed. There are two types of trusts. There's revocable and irrevocable. Revocable, as you can see in this image, you can take it back. You can change your mind. Transfer into the trust, but you can take it back. And they're going, what in the world just happened? Income is taxed at a grantor rate there, which is a higher rate. So if you have the ability to change your mind with the money in this trust, then you're going to be expected to have a higher tax rate. They want commitment. They want commitment. Irrevocable trust, no takebacks. And you are taxed at the rate for trust, which is going to be less. There you go. Revocable, irrevocable. Sometimes it's called non-revocable. I guess they're both right. Corporate income taxes. Only for corporations, not individuals. Preferred and common stock dividends. Proceeds from issuing stock are not taxable. So if they issue new stock, then the proceeds are not taxable. Okay? Dividend exclusion. If a corporation owns less than 20% of another company, then 50% of the dividends they receive from that company can be excluded from tax. If a corporation owns 20% or more of another company, then 65% of their dividends are excluded from tax. And also, there is something else cool that they're allowed to do. When selling, they can determine which shares to sell in order to minimize taxes. They can do that. Estate and gift taxes. Income taxes are paid by the person who receives the income. Okay. Estate and gift taxes are paid by the person who gives the money, not the person who gets the money. And this is a progressive tax based on the size of the gift. And we know what progressive means. So again, the estate and gift taxes are paid by the person who gives the money, not the person who gets it. And that's logical. It's not like they're going to leave somebody a gift and then the person receiving the gift is going to say, thanks a lot for the gift. Now I owe taxes? Or now I owe taxes. She didn't have a question in her voice. Okay, let's look at these two progressive taxes. Progressive taxes. There is an estate tax exclusion and a gift tax exclusion. Estate tax exclusion is currently at $13,610. It is periodically adjusted for inflation. That amount is excluded from taxes. A married couple is completely excluded from estate taxes. Remember, that's why we have A and B. They may divide up their estate. Remember when we talked about that? Yep. Okay, gift tax exclusion. Any gift above $18,000 must be taxable. Now, the recipient cost basis is the lower of the original versus the current value. So that's cool. Unified credit. The amount due in estate taxes are any estate tax above $13,610 and any annual gifts above $18,000. So that's the unified credit. So you can use the estate tax and the gift tax. Combine them. That's cool. Charitable donations. Charitable donations made by descendants are not taxable. Makes sense. There are some other permitted deductions. Funeral expenses, admin expenses, legal fees, claims against the estate like unpaid bills, mortgages against the estate, owned property, assets donated to charities, and any estate tax liability owed to the state. All of these are permitted deductions. So only the net estate over $13,610 is taxable. All of these can be deducted. Cost basis of inherited asset. This is based on the value at the date of death. The tax payments must be made 9 months after death. Okay, they give you a little bit of time to grieve, and then they want their taxes paid. There is an alternative valuation date. So if something lost value, you have 6 months after death to be able to use the new valuation date to look at the cost basis for taxes. And there is a generation skipping tax. If it's left to someone 2 generations or more below, then the maximum estate tax amount must be paid. Wow. So that little kid right there is going to get nailed with taxes. Okay. Alternative minimum tax. So, this is called a tax on tax preferences. It keeps people from paying no taxes. Look, this person is trying to run away from paying taxes. So here are the allowed. You can add these back in to calculate the taxable income. So you're allowed to add back in accelerated depreciation in excess of straight line, excess intangible drilling costs, excess percentage depletion deductions, municipal interest income, and exercise of any incentive stock options. You can add that back in to be taxed, to be looked at as taxable income. Now, if the alternative minimum tax is higher than the regular tax bill, they must pay the higher amount. The tax preference items are looked at to make sure the person pays taxes. These are not allowed as deductions when computing AMT. Personal exemption, standard deduction, state and local tax deduction, and miscellaneous deductions. Those are not allowed. They want you to pay some taxes, so they're going to get their money. Okay, last section here. Personal bankruptcy, also called Chapter 7. All non-exempt property is turned over to a trustee. The property needed for living and working is exempt, including household goods, furniture, clothing, car, portion of equity in the home, and tools needed for work. Non-exempt is sold off by the trustee and used to pay creditors. If the creditor is secured, like a mortgage on a home or a car loan, the asset is sold by the trustee and the proceeds pay the loan. If the sale proceeds from the secured debt aren't enough, oh well. If it's sold for more, the remaining goes to pay the other debts. And that's it. That's the end of this section. Let me know what you think. Hopefully this has been helpful, and I hope you have a great day.